A lot of it, especially with the benefit of a little hindsight, looks pretty textbook. You know, we got the weak seasonal period, market at a high, August, September, October a week, late October, low off of a correction. Bond yields come down, retrace some of their gains. Where does that leave us right now? Because a lot of the complaints about this market going into this phase was it's too top heavy. It's only a few stocks working. Can the economy handle yields at this level? Where are we now?
Yeah, it was too top heavy. And what you're seeing now is a market that's broadening out and will likely continue to broaden out. The reality is we're in a nice patch here, which is inflation's come down and the unemployment rate has stayed low. So you look at a misery index, it's interesting. A lot of Americans aren't feeling good about the economy or about the direction of the country. But the reality is the misery index at 7%, which is unemployment rate plus inflation, is quite low. So this is a market that's likely to move higher. And it's going to be more of a risk on environment than what we saw during that time of a top heavy market.
It seems as if, you mentioned this kind of window that we're in right now, after the Fed has likely done all it's going to do on interest rates, the economy's still growing reasonably well, unemployment's still low. Usually there is a little bit of a period where markets can perform pretty well in there, although this market, this cycle hasn't always conformed to these rules, I guess is one thing worth saying. But also, it still leaves us, though, with that persistent, aren't we in the latter part of the cycle? Aren't we just waiting for the lagged effects of higher rates to work on the economy and therefore corporate earnings?
Yeah, at some point, the economy is going to slow. It's been more resilient than many had expected. We saw a lot of mea culpas from people expecting a recession by now. But even in a slowdown in the economy, equity markets tend to do well. So as you think about 2024, the way we're thinking about it is we're expecting to come in with a market that's broadening, leadership in value, smaller caps, international, things that hadn't worked well recently. And then as the economy starts to slow, you tend to want to shift into more quality equities again. But to me, what I come back to is the principles of by the time you get to peak inflation, which we had already 15 months ago, and peak tightening, you tend to see markets do well over the subsequent years. So even if we have some hiccup around the economy, call it late 2024, early 2025, history suggests that markets do well after inflation has peaked and come down. And that's over 2, 3, 4 years.
And unprompted, you did say your word of the day, which is peak, right?
Peak.
Yeah. Across the board, you're seeing that the market's kind of feast off of all that. Just quickly, where does it leave you with regard to those very large stocks that have gotten that quality premium in the NASDAQ that have driven the gains this year?
Yeah, I don't think it means that those stocks do poorly. I think it means that they underperform on a relative basis, which means you want to diversify. If you're an investor right now and you're sitting in money markets, which a lot of investors are, and you're sitting in growth stocks, diversify. So when the money markets move out and lock in some of those yields, go into corporates, municipal bonds, and on the equity side, add some value, small cap, international.